Welcome back, my friends. U.S. home prices are in the midst of a major correction or even a collapse. Institutional home buyers bought houses over the past few years as if they were going out of style. That included iBuyers like Zillow, Redfin, Opendoor, and OfferPad. It also included small-time investors and home flippers. But now, the tide has turned, mostly due to quickly rising interest rates. General sentiment about house prices has been thrown into reverse. And all of these buyers who rushed in are now exiting just as fast. The U.S. housing market is seeming like a speculative bubble once again. And house prices in the United States are in decline. Today, we are hearing news that Blackstone has taken heat over the past week. Blackstone is limiting withdrawals from its $69 billion private REIT. For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. And there are probably a number of investors in the REIT that think real estate prices will further deteriorate. So, what does this mean for Blackstone? What does it mean for REITs? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. What is a REIT? A REIT is an investment fund that invests in real estate. It could be structured as a mutual fund, almost like a stock mutual fund. Or, it could be set up as an exchange-traded fund, or ETF. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. It could be any kind of real estate. But most REITs invest in commercial real estate. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private REIT. President and Chief Operating Officer John Gray defended the positioning and structure. Gray noted that investors knew BREIT had limits on redemptions. BREIT stands for Blackstone Real Estate Income Trust. And, as I am sure you know by now in this video, BREIT is not structured as an exchange-traded fund. So, investors in the fund cannot just sell their shares anytime the stock market is open. Instead, they need to contact Blackstone and request a redemption of all or a portion of their shares. Even if a fund is not tradable on the stock market, it is normally still divided into shares. Well, several investors in the BREIT fund decided that they would like to withdraw some of their money. And, it seems that the BREIT is receiving redemptions for more than the amount of money that they can quickly make available. Real estate investment trusts own real estate. And real estate is not a highly liquid investment. So, the fund needs to make some sort of judgment as to how much cash it should make available for redemptions. And, in this case, investors in the fund want to take out more money than Blackstone can make available. Investors nervous about Blackstone's real estate investment trust should view it as a long-term vehicle that's well-positioned for the future, Gray said Thursday. That move followed redemption requests that exceeded previously set limits. Shares in Blackstone stock have fallen 8% over the past 5 days. Analysts from Barclays downgraded the shares of Blackstone. For those of you not familiar, Blackstone is known as an alternative investment firm. Barclays analysts cited controversy surrounding the BREIT fund for the downgrade. We set up the product with limitations on liquidity, Gray said. We described it as semi-liquid because we knew at some point there would be a period of volatility, Gray continued. And we didn't want to sell assets at the wrong time under pressure, Gray also said. In exchange for their patience, investors have benefited from a fund that has delivered 13% compounded returns for 6 years in a challenging environment, Gray also said. As you might imagine in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, The $35 billion Vanguard Real Estate ETF has plummeted 26% year to date. The key theme here is that performance has delivered, Gray said. The structure we put in place is operating exactly as we intended 6 years ago, Gray continued. And we are incredibly proud of the performance and the structure, Gray said. Investors should look at Blackstone and say, "You guys have done an incredible job at deploying our capital in exactly the right geography," Gray continued. "And in exactly the right sectors with the right balance sheet," Gray added. "I think they have confidence in us," Gray also noted. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. New subscriptions in the fund experienced a major drop-off. Subscriptions fell to less than $500 million. That compares to $880 million in September. "We can sell assets to meet redemptions," said Gray. "But to do so over a time horizon that will be beneficial," Gray continued. "We can sell if needed," he said. "That's what gives us a lot of confidence," Gray noted. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. Meanwhile, Redfin shut down its institutional home buying. And it is selling off its portfolio of homes as quickly as possible. Astonishingly, Opendoor reported having more than 2,000 houses in the purchase process at the end of Q3. These are the areas with largest share of institutional investors selling properties. Metropolitan Memphis, including Tennessee, Mississippi and Arkansas with 19.7%. Jacksonville, Florida with 18.3%. Macon, Georgia with 17.6%. Atlanta, Sandy Springs, Roswell, Georgia with 16.8%. Metro Clarksville, including Tennessee and Kentucky with 16.7%. Charlotte, Concord, Gastonia in North Carolina and South Carolina with 16.4%. Lakeland, Winter Haven, Florida with 15.8%. Phoenix, Mesa, Scottsdale, Arizona with 15.4%. Indianapolis, Carmel, Anderson, Indiana with 15.1%. Prices of single-family homes can still fall. That is because individual home buyers are still the vast majority of the market. And that includes many buyers who need to borrow money to purchase a house. So, mortgage rates have an outsized impact on the price of homes. Mortgage rates have doubled since January. That has crushed buyer demand and cratered values in real estate investors' favorite cities. Phoenix, Las Vegas, Jacksonville. It is a stunning reversal of fortune for flippers. They are now stuck with homes to sell and with loans to pay. The U.S. housing slowdown is roiling the real estate industry. This is causing buyers and sellers pull back from the wacky market. It is a huge blow to home flippers. Home flipping reached a fever pitch at the start of the year. 10% of all real estate transactions were flips. But, the home flipping rate has been falling since Q2 and economic conditions are weakening. Demand has cooled spectacularly fast in Sunbelt cities. And in pandemic-era boomtowns where affordability has been strained. Boise, Salt Lake City, Denver, Las Vegas, and even Austin. Flippers accounted for 14% of transactions in those cities. Profits on home flips declined from 30% to 25% in the past year. In Austin, for example, flippers lost about 1%. In San Jose, flippers' profit fell from 45% in March to 6.5% in August. Institutional iBuyers Redfin and Opendoor are also getting burned like traditional flippers, only on a larger scale. 42% of the homes that Opendoor sold in August sold for less than what it paid for them. Opendoor lost money on 76% of its deals in Phoenix. Betting on rising U.S. real estate prices was a winning strategy for at least a decade. But the markets have reversed course and houses are attracting lowball offers. But prices seem to be declining every week as sellers get more desperate and buyers back away. Home builder sentiment is in a record collapse. What appeared to be a slow and mild downturn has picked up steam every month since then. New home sales are down almost 30% from a year ago. And existing home sales are down 20% from a year ago. Sensing that home prices are in free fall, home buyers are now pulling back from the market. The United States economy now teeters on the brink of recession. Housing prices are falling in many U.S. cities. But how far will they go? Experts predict that house prices could fall by up to 25% over the next few months. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.